What if one ETF could give you instant access to the companies keeping America alive? From drug giants to insurance powerhouses, XLV holds the very businesses that profit, no matter what's happening in the economy. But is that a good thing? Or is this just another slow-moving fund flying under the radar? Today on Opportunity Odyssey, we're breaking down XLV, the healthcare ETF that's quietly dominating the market and might just be the most overlooked asset in your portfolio. Stick around, because the deeper we dig, the more interesting it gets. XLV is an ETF, that's short for Exchange Traded Fund, which means it's basically a basket of stocks you can trade like a single share. But this basket? It's full of American healthcare heavyweights. We're talking Pfizer, Johnson & Johnson, Merck, AbbVie, United Health Group, and Eli Lilly. It tracks the Healthcare Select Sector Index, which covers a broad range of companies, from drug makers and biotech firms to insurance giants and medical equipment providers. Instead of betting on one winner in the healthcare race, you're betting on the whole track. Let's be real, healthcare isn't optional. As the US population ages and medical technology advances, healthcare demand keeps climbing. XLV captures this trend, and it's built on the backs of companies that are thriving from it. It also offers an extremely low fee, just 0.1%, and over $40 billion in assets under management. That's a lot of confidence from investors. So, how's XLV actually performed? Over the past decade, it's delivered average returns of around 9 to 10% per year, comparable to the S&P 500, but with less drama. It's considered a defensive ETF, meaning it often holds up better in market downturns. In 2020, while many sectors dropped, XLV stayed strong thanks to healthcare's critical role during the pandemic. But no investment is risk-free. XLV is heavily exposed to a few companies, meaning if United Health or Johnson & Johnson dip, the whole ETF feels it. There's also significant regulatory risk. Changes in healthcare laws, Medicare, or drug pricing could hit these stocks hard. And since XLV is entirely US-focused, it doesn't offer global exposure. So, who should consider XLV? It's great for long-term investors who want steady growth without chasing hype. It can balance a portfolio full of high-risk tech or volatile sectors. If you're betting on long-term trends like aging populations and rising healthcare demand, this ETF makes sense. It won't 10x tomorrow, but it might help you sleep better at night. In a world full of risky bets and loud headlines, XLV is a quiet giant. No gimmicks, just companies that provide essential services to millions of people. It may not be exciting, but sometimes boring builds wealth. This video is for informational purposes only. It is not financial advice. Always do your own research or consult a licensed financial advisor before making investment decisions. Investing involves risk, and past performance is not a guarantee of future results. Thanks for watching Opportunity Odyssey. If you learned something new, hit the like button and subscribe for more ETF breakdowns and investing insights. Got a topic you want covered? Drop it in the comments and keep chasing opportunity.